right away go into the technical session. NRI Taxation recent amendments by CATP Ostwal sir. Ostwal sir is the encyclopedia of the taxation. Over to you, sir.
Sri Ramaswamy ji, Mr. Soni and other office bearers, my seniors, ladies and gentlemen. It is a great opportunity to deal with the subject and share my thoughts on the subject with fellow members, chartered accountants in Dubai, chartered accountants elsewhere, and in India. The subject given to me was recent amendment to the residential status of non-residents under the Income Tax Act. The Finance Act 2020 amended the provision, and that created a lot of tension amongst the just a minute. How to run, I'm seeing it. Okay. The provisions have been created this year and they are effective from the current year, that is from 1st April 2020 to 21 will be the first impacting year. So therefore, all these amendments which have been made are not going to have any impact till the last assessment, up to 31st March 2020. So that is assessment year 2021. And all these amendments have been made to only one section, section 6 of the Income Tax Act. And you will have to understand the concept of taxation of non-residents under the Income Tax Act. I'll take you through everything. I'll explain you the nuances of the amendment made and also the areas of concerns, benefits, etc. And then I just now saw some questions have been sent to me. I think Mr. Soni has sent a set of questions, around 30-40 questions. Time permitting, I'll deal with all. I have no problem in dealing with all these questions, though I have not read them earlier. Just now I saw on my phone, and I can deal with as many as possible. Now, as far as scope of this section, scope of this presentation is concerned, I will deal with section 6, the scope of the income as far as non-residents are concerned, and background of section 6, what made them to amend, and what is the impact of the amendment in the provisions of the section amendment to Income Tax Act. Section 6, as you all know, is a test which decides the residential status of an individual. Section 6 also deals with the residential status of companies, also HUF and partnerships and all other. We are not right now dealing with all other entities other than individual, but Section 6 was amended 2 years before to deal with the amendment for the companies. If the company is controlled from India, controlled and managed from India, it was considered as resident. But in 17, they changed the law. Now they say we are not concerned with control and management. We are concerned with place of effective management. In other words, if the company is set up abroad, and now since the background I heard from all of you that you are wanting to return to India, and therefore suppose a company is set up abroad, and if that company, when you are returning in India and you are going to control that company, the place of all the decisions of that company are taken from India, then the place of effective management of that company becomes an India. And once the company is having a place of effective management in India, then it will be resident of India. It will be liable to tax on its world income. And that is and this is not the Indian amendment. This is what the world is also trying to change their laws, and the people are copying based on the OECD guidelines. So therefore, this is one major change one has to keep in mind. So whenever a person comes back to India, and has companies abroad, he should not control those companies. All commercial and management decisions of that company should be taken by people who should be appointed in that country, and they take the decision. And now the issue is Indian revenue authorities are very intelligent. What they do is everybody these days is operating through computer and through technology. So when they come for search, when they come for survey, they just straightway take your computer and copy the data and look at your emails, communication with other companies, and then from that they can find out all the decisions are literally taken by you. Though on paper you are saying they are controlled and managed, they are all commercial and residential commercial and management decisions are taken from foreign country, in reality that is not correct. And therefore you run the risk of the foreign company being treated as a resident of India. That care one has to take. This was not my subject, today's subject, but nevertheless, I will, if there are any questions, I will deal with all those questions as well. Around the world, the residency of an individual is categorized as resident and non-resident. But in India, we have three categories: resident, non-resident, and resident but not ordinary resident. This is the category not found anywhere in the world. Reason being, it is a safe harbor period. If you are becoming resident, if you are a non-resident and virtually you want to become resident, you are given 2 years time period, so that in the 2 years time period you can arrange your affairs in a foreign country in such a manner that those incomes once you become fully resident, you can avoid taxation. And that is the reason why resident but not ordinary resident status is a category in India which helps people to remove a lot of difficulties. That we will come to little later. Now, if you look at, we have history of the Income Tax Act. 1922 was the year when we started Income Tax Act. And under Section 4A of the 1922 Act, we had at that time, prior to independence in 1947, India had British controlled India and non-British controlled India. And there was a trade between British controlled India and non-British controlled India. And therefore the tussle of taxation used to happen even in those days. The question arose is, what is the residential status of a person? It became for testing before the Privy Council. And in India at that time, the definition of under 22 Act was that if the person has a Indian income more than a foreign income, then he will be deemed to be the resident of India. And of course, those are not relevant, but the matter was challenged before the court, and the court said that constitutionally this is valid, and therefore they are entitled to do that. And that got power to income tax authorities in India to believe that they can do all changes in the Income Tax Act. And one of the reasons why they have changed is the change in the Income Tax Act is based on the income criteria. You have got, Ramaswamiji has explained that you have got income from Indian sources exceeding 15 lakhs of rupees, then you can run a risk of becoming resident. That is what we are going to see. And the tax authorities, when we talk to them, they believe that we have necessary powers. Supreme Court of India held it to be constitutional. Wallace Company's decision is way back, very old decision. They say it is a valid, and therefore it is the decision of 1948, and therefore we will still be able to tax you. And therefore we can't fight a big battle with them, but nevertheless we need to plan out our affairs in a proper manner. Before going to Section 6, let's understand the scope of the income. If you are purely a resident of India, India taxes the income of the resident like all other country, whole world income liable to tax in the hands of resident. But I withdraw my words, whole of the world, because you are living in the world where there is no tax. You have a number of countries where the taxation is on a totally different manner. That is on a receipt basis. So they're like Singapore, receipt basis taxation. Or the Hong Kong, accrual in the country is taxable, nothing else. Outside accrual is not taxable. So there are a number of countries which are having its own taxation system. But most of the countries in the world, tax the resident on the world income. Then what we have done in India from beginning, a resident is taxable on income received in India, income accruing in India, income deemed to be received in India, income deemed to accrue in India, and income accruing and arising outside India. Everything is taxable here. So therefore global income is taxable. The resident and non-resident, I'll come to not ordinary resident little later. Non-resident is taxable only in respect of income received in India, deemed to be received in India, accruing in India, and deemed to accrue in India. Nothing more. So therefore, the concentration on non-residents taxation is India-centric income. Concentration on taxation of resident is world income, literally. In between the two categories, we have, in between one category is not ordinary resident. Not ordinary resident is akin to, but not necessarily exactly same. Akin to non-resident. He is also not taxable on its world income, but only one category of the income has been treated as taxable. If you have got any income arising outside India, but it is derived from a business controlled or a profession set up in India. For example, I have set up my profession in India and I get the income abroad and I park that income abroad. I have branches abroad. Still it will be income set up from profession in India. Or I have a set up business set up in India and I have also branch of the businesses abroad. I am not ordinary resident. That income will be treated as taxable in India. And therefore this issue is, what is income controlled, business controlled or a profession set up in India is still not defined. And that is creating a lot of issues, and that has been a major issue for discussion during the current year. In fact, I gave two examples in my earlier lecture. Take the case of a person like Harish Salve, who is an Indian citizen of India, but now settled in UK. When he set up his profession, he started profession from India. And therefore now today he is controlling that profession by sitting in UK. Can you say that it will be set up, it will be said as profession set up in India? Is a major issue. Therefore, there is no clarification on that. Now, if I am raising this issue in the name of Harish Salve, possibly he is the one person who will be able to defend it before Supreme Court, saying that my profession set up in India is different than my profession set up in UK, and that can benefit all of us here. Section 2 subsection 30 defines non-resident, means a person who is not a resident. And for the purpose of section 9, now this definition is very negatively put it. A person is non-resident who is not a resident. Fine, understandable. But the benefit of that is extended in some sections. Sections 92, that is transfer pricing provisions, 93 control companies provision, and section 163, person to be regarded as an agent of a foreign entity, are also applicable only to the resident and not to not ordinary resident. And therefore, this is a benefit to that extent is available to the person. Now, I'm just saying if it is not relevant, I'll just pass it to faster. Now, while calculating, now person is regarded as resident of India. I think this section, this issue will come up a little later. That's why I would like to park it and then come up as and when the discussion takes place. In India, please note one thing: resident under the Income Tax Act and resident under the Foreign Exchange Management Act, we have two different acts. There is both the section both the laws talks of resident and non-resident. Both are on a totally different footings. They have nothing to do with each other. Income Tax Act regards the resident based on number of days stay. No doubt the similar stay has been introduced under the Foreign Exchange Management Act. They say under the Foreign Exchange Management Act, residential number of days stay of the earlier year should be counted and not the current year. In the case of income tax, number of days stay should be of the current year should be counted and not of the previous earlier years. And therefore, there is major confusion which comes up, and hence, while calculating, while deciding the taxation issues, we should not mix up with the foreign exchange issue, Foreign Exchange Management Act issue of the residential definition. Both have different ramification. All your investments made abroad, received in India and made in India are subject to FEMA regulation, but its income and taxation of that income is under the Income Tax Act. And therefore, Income Tax Act has a limited implication, whereas FEMA has a larger implication. While calculating number of days stay in India, there are controversies which I would just like to take it here at this point in time. At times, what happens when you go abroad from India, you leave at 11 o'clock in the night. Your flight from Dubai is at 10:30. and you leave at 10:30, the whole day you have been in India. The question is whether you will be regarded that day when you have left India, that whether that day will be counted as in India. Answer is yes. Now, therefore, people plan it out. People leave immigration stamp, they take it after 12 o'clock, so that you are counted on the next day as only the is in India and not the day when you actually literally left. So therefore, one should calculate carefully. Indian Advanced Ruling Authority all along have been taking a view like Income Tax Department takes, that when you have left India and when you arrived in India, both the days should be treated as you are present in India. Whereas Income Tax Tribunal has taken a view and consistently either of the days should be counted as in India and not both the days. So therefore, while planning, you should calculate both the days to be in India, the day when you have left and the day when you have arrived. But if you are forced to have a litigation, then in my opinion, in the litigation situation, you can defend yourself based on the tribunal decision, and you have a better position following the tribunal decision. Then number of other concepts like economic presence, legal presence is irrelevant for the income tax purposes. Income tax purposes only says number of days stay, that's all, nothing else. India does not, so far, did not regard citizenship as the basis of taxation. We have two countries, one is Artia and second is USA. USA is a major, Artia is a very small country, very near Sudan, which is not relevant. But USA is only country in the world, major country, which taxes the citizen of USA irrespective of fact, whether you are in USA, whether you stay abroad, we don't care. You file your return here, pay the tax here. If you already paid the taxes abroad, get a credit for those taxes in USA, but you will have to file your return. So citizenship is very relevant. Whereas in India, citizenship hitherto was not at all relevant for the income tax purposes. Income tax just considered the definition of resident under Section 6 of the Income Tax Act and nothing more, nothing less. However, during the year 2020 Finance Bill, they have brought in the concept of citizenship for a limited purpose. If you are a citizen of India and if you are not citizen of India, then the question is how many days you can stay here, and all these income, what number of days criteria is decided under the law, and there are reasons to do that. We will come to that when we come to the relevant portion. Very interesting discussion on that, because this is very, very important. The importance of the double taxation avoidance agreement still continues. Unfortunately, or sometimes maybe fortunately, the treaty with Dubai has a definition of Dubai resident is totally different than the definition of resident under all other tax treaties India has. India's only unique treaty with the one or two treaties where the number of days stay is considered as a residential status as a resident of that country. For example, in Dubai Treaty, you say if you are in Dubai for more than 183 days, you are a resident of Dubai or UAE, and not on the basis of domicile or any other criteria of the similar nature. Whereas all other countries, the definition is different. However, if you are a resident of two countries, suppose by virtue of your stay in Dubai, you are a resident. And in India also, by virtue of number of days presence in India, you become resident. So, and therefore, in a situation like Dubai, it is possible to avoid because there is 183 days test in Dubai. Whereas in India also 182 days test. So therefore, if you have more than 182 days, you become resident. So you can't be, except in the leap year like this current year, you can be resident in two countries, 183 days in Dubai and 183 days in India, then you become resident of both the countries. And in such a situation, you have Article 4 sub Article 2 of the treaty, which says if you are a resident of more than one country, or you are a resident of both the countries, then the tie-breaking test is provided under that treaty. And they say, where is your habitual abode? First condition. Then that is the basis where you will be taken as a resident. But you say I have an habitual abode in both the countries. Okay, in that event, where is the center of vital interest you have got? You are employed abroad, you are earning abroad, and your family is abroad, and your economic nexus is abroad. So therefore, generally the tie-breaking test should be in favor of that country where all these economic nexus exist. But if suppose you say your facts also suggest that your parents are in India, some of the children are studying in India, then economic and your investments are also in India. The economic nexus also could be in favor of India, and therefore you can be regarded as a resident of India. So in such a situation, a dicey test is the third test comes to the rescue. Where is your permanent home available? And if your permanent home is in foreign country, then you can still be out of the India and therefore not liable to tax. The fourth test is risky for you because Dubai does not allow the passport of that country, the Indian passport you are holding, and therefore fourth criteria is where of which country you are a citizen, you will be regarded as a resident. But first three criteria should satisfy so that you will become resident of that country. And then once you become resident of that country, India takes a view, India has taken a view. If you are a resident of foreign country, you will be regarded as non-resident of India under the treaty and for all the purposes. And therefore this becomes beneficial. Now, what happened? What was the reason for amendment to Section 6 of the Income Tax Act in India? Modification in residential status. Now, existing rule, of course, everybody knows. I don't have to labor much about it to explain. If you are abroad, if you are in India less than 182 days, you are non-resident. If you are in India less than 182 days, in India means more than 182 abroad. If you are in India for more than 60 days and in the preceding 4 previous years, more than 365 days in a year, then you will become resident of India. In other words, however, very interestingly, so far, the 60 days criteria was replaced by 182 days virtually everywhere. The 182 days, if you are leaving India for the first time for the purpose of employment, if you are a member of the crew on an Indian ship or any other ship, then you are leaving India and you are a citizen of India, then 182 days gets replaced in place of 60 days, and therefore virtually you become non-resident if you are abroad for more than 182 days. So if you are more than 182 days in India, then only you can become resident of India, not otherwise. And thirdly, if you are non-resident and you are coming to visit to India, this was law till last year. If you are coming to visit to India for less than 182 days during the year, then you also become non-resident. You are not required to be called as a resident. Interesting decisions which have come in on this particular last aspect. If you are non-resident abroad and coming to India for visit, and then in that case you are permanently coming back and not going back at all, then in that case you will not get the advantage of 182 days because you come back. Your number of days in India are more than 60 days, and therefore you will be hitting there in the earlier clause, and therefore in a case where you are returning back to India, at least ensure in that year you are in India for less than 60 days, or you are in India even if it is exceeding 100 days or more than that, and you are say if you are in India up to say 182 days you are in India, and then just last few days you are in India, go out and then come back in the next year. Advisable course will be not to come and settle immediately. Ensure that your residential status planning is done properly. I'll explain this again little later. But the law is now changed. What is the rationale behind changing the law? What happened, you know, that one people used to have one interesting tax planning. A Spanish citizen, Indian Spanish citizen, origin person of Indian origin, having fully settled in Spain, having office and also the residence in Dubai, having residence in London, and having also residence in some other countries, Hong Kong. And he is staying in each of the country for a particular threshold number of days. For example, UK consider less than 90 days stay Even if you have a residential house there, you are not a domicile or you are not a resident. In Spain, 182 days criteria was there, so therefore you will stay there for say 100 days. In UK, you will stay for say 75 days. And then in India, you come and stay for say 180 days. And then few more days in Dubai and some other countries. So by way of this, you plan out your affairs in such a manner that you visit all other countries, all of the world, and don't be tax resident of any of the country. You are paying taxes on incomes earned in those countries. Only on that income you pay the tax if the income tax is leviable on non-resident in respect of those income. But you will take advantage. You will take the advantage of the provisions like Indian law, where the non-resident is allowed to invest and earn income and not liable to tax. And therefore you will not be taxable at all. Or you will keep your investment in a country like UAE and there earn income or income therefrom, and you will not be taxable. Interest earned by a non-resident in UK also is not taxable in UK. Singapore also is not taxable. So in Hong Kong is also not taxable. So you will work out the situation of world situation and then say I am not taxable anywhere. So such persons are called as stateless person. They don't have any state. In such a situation, how to tax them? This was a global problem. And when they found this is a global problem, OECD and all other countries started working out a plan how to tax them. And now you can see, the income disclosure schemes, the foreign assets disclosure schemes, cross exchange of information programs, which countries are running under the guidance of the OECD, are major source, major problematic areas to catch hold of people who are not reporting their income properly. This is not applicable to you because in UAE there is no tax at all. On the contrary, to protect yourself, people take the shelter of Dubai and stay there. Of course, in a situation like COVID, that is a problem. I'm not suggesting anything on account of that. But that used to be the tax planning technique. People would have some residence permit and park their income, park their profits there. So, but now under the exchange of information program, country by country reporting world over, these problems are getting narrowed down gradually, slowly. And this is under the global program. OECD is directing the world. India is also under their influence and control. But because of that, because we also wanted to tax these non-residents who are living in India, and you see what happened in last 3 years, when we created the Black Money Act in India, 2015, India introduced Black Money Act. And the Black Money Act thrust was a non-resident, a person who becomes non-resident, he was skipping the application of Black Money Act. Black Money Act was applicable to a resident. If it means if you have parked your money abroad and thereafter you became resident, the government of India was not in a position to do anything. Of course, last year they amended the law retrospectively, saying that you can be still caught if the monies which you have earned abroad, monies which you have not disclosed to the Indian tax authorities, but earned abroad and parked, stashed abroad. In that case, we will catch you, provided that income was earned when you were resident, even prior to becoming non-resident. And earlier it was a complete ban, but now they have said retrospectively we can tax you. So therefore, this is one area of concern which Black Money Act introduced. And gradually then people realize that if this is the case, let us become non-resident, let us become non-citizen of India. And there was huge movement of people getting out from the country and going to other tax haven countries or going to the countries where low tax jurisdiction, low tax countries, and they're taking up either citizenship or shifting their residence, which was going on. And almost 20,000 people who are high net worth individual have shifted from India and went abroad. And to catch them, the government was trying to plug the loopholes and catch them and try to work out scenario whereby they will be caught in the net. One of the themes seems to be 183 days was a very long period, 6 months period. people would come and stay in India, and then thereafter they will go abroad and stay abroad for more than 183 days, and therefore you will still be non-resident. So they have curtailed the period of 183 days to 182 days to 120 days. I'll come to that now. What is the provision earlier, which I explained to you earlier, that if you stay more than 182 days in India, then you are resident. Second condition is if you stay more than 60 days in that year, and in the preceding 4 previous years, more than 365 days, then cumulatively, then you become resident. Now, in play, particularly, there are 2 exceptions. If you are living in India, for the purpose of employment abroad, or you are a member of the crew, then instead of 60 days, you are allowed to stay in India up to 182 days. Now, this in this clause of 160, sorry. And secondly, if you are coming back on a visit, to India, when you are non-resident and you are wanting to come back and you have personal economic connections, tie-up, medical facilities, your business here, your relatives are here, you want to meet them for marriages, etc., because you are ultimately Indian. So you are coming back to India, person of Indian origin or citizen of India, they were allowed to be coming back and allowed to stay in India for 182 days, which they have changed to 120 days. This is a major change which has happened, and therefore, whenever the word 60 days was used, there 180 day was permitted to stay here and not more than 182 days. However, there was huge hue and cry. Dubai residents, particularly Middle East people, made big noise, and the government came down and government tried to change this regulation. And now the effect of the change in the regulation is, in case if you are coming back for the visit to India, you are allowed to stay in India up to 120 days if your total income liable to tax in India is more than 15 lakhs of rupees. Other than foreign income. Foreign source income is not taxable at all here. But if your income from India is exceeding 15 lakhs of rupees, then you are allowed to stay only up to 120 days. So that was the reason I gave you earlier the Privy Council's decision. Income criteria and citizenship criteria has become relevant now. I'll explain now in that context. But if your income is less than 15 lakhs of rupees, total income, I'm saying the word total income, and the total income is the term defined under the Income Tax Act. Total income exceeds 15 lakhs of rupees, you can stay up to 120 days. But if your total income is less than 15 lakhs of rupees, still you can continue to stay in India for 182 days without any problem. So therefore, the intention, therefore it is possible for you to still stay in India to up to 182 days when you come for visit, provided your income in India is less than 15 lakhs of rupees. Now question is, what is the income which is less than 15 lakhs of rupees? For example, your NRI deposits here, FCNR deposits, interest earned thereon is not taxable. And it is not taxable, and therefore it is not included in the total income. So the total income means only taxable total income. What is not taxable is not relevant. Forget about it. Now, for example, you have got an income. When you calculate your total income, and therefrom you give deductions, donations, etc., that also should be deducted, and net total income should be calculated. If net total income is more than 15 lakhs of rupees, then only you become resident if your stay exceeds 120 days. If your stay is less than 120 days, you are non-resident, not to bother. But if your income exceeds 15 lakhs, you become resident. However, new criteria which have been added is deemed residency, which we'll come to later. Then, if you have got any income which is less than 15 lakhs of rupees, then your total stay in India permitted is 182 days. That still continues. So this applies to citizen of India and person of Indian origin only. The non-citizens, the non-citizen of India, they are not covered by these exceptions. They will be still covered by the provisions of 60 days stay in India only, and not more than that. The existing rule, as I said earlier, it applies only up to assessment year 2021. That is, new rule will apply from the current year onward, and therefore this new rule was created for the stateless persons. They were not taxable. They were roaming around in the world, having income everywhere, not paying taxes anywhere, and therefore India wanted to catch hold of them and get it taxed here. And this was also based on some scientific study. Indian government did it, and because most of the people started going out of the country, which were all high net worth individual, and the government wanted to catch hold of their taxation in India. So 15 lakhs of rupees, the question, so there was some question which has been put on this forum. I will try to take up those questions at the end and I'll answer. 15 lakhs of rupees, let me repeat it again. 15 lakhs of rupees income, which is taxable income and not the exempted income. You exclude exempted income. For example, prior to going to Dubai or abroad, you had an agricultural plot here and on which you are getting an agricultural income, because once you become non-resident, you cannot acquire agricultural land. Prior to that, you had an agricultural land and you continuously use somebody to get the agricultural income. Agricultural incomes are not taxable in India, and therefore it doesn't enter the total income, and that's no problem. Now, Section 6, therefore, further to the amendment which we have discussed, a new criteria which was created in the Income Tax Act, and that is says, the subsection 1A which has been proposed. It says, notwithstanding anything contained in subsection 1, an individual being citizen of India shall be deemed to be the resident of India. Deemed resident of India is a new criteria which have been added. In the previous year, if he is not liable to tax in any other country or territory by reasons of his domicile, residence, or any other criteria of similar nature. So therefore, if you are a citizen of India and you are staying abroad and you are not taxable anywhere in the world, not liable to tax in the world, then you will be regarded as a resident of India and liable to tax in India. Now, this has created a lot of tension, lot of problem, and all of a sudden, when this was introduced, immediately Central Board of Direct Taxes created a clarification saying that this will not apply to the UAE resident, and therefore this was an amendment proposed which lived only for say 10 days or 15 days, because the law was again on 23rd March was amended, and thereafter the new provision which have come into effect was like this. They brought in the concept of the 15 lakhs of rupees income for deemed resident as well. What the law says now, after amendment, full-fledged amendment, that earlier was a draft amendment. Now the amendment which has been brought, the notwithstanding anything contained in clause 1, an individual being citizen of India having total income other than income from foreign sources exceeding 15 lakhs of rupees, other than income from foreign sources, again an undefined term, but we shall assume that Indian income. Therefore, an Indian income exceeding 15 lakhs of rupees during the previous year shall be deemed to be the resident of India in that previous year, as if he is not liable to tax if he is not liable to tax in any other country or territory by reasons of his domicile, residency, or any other criteria of the similar nature. In case of Dubai, these criteria are not applicable. The criteria in Dubai is only 183 days stay. Now, question is, what is liable to tax in any other country? The term liable to tax in a country is different than term subject to tax in another country. Subject to tax in the country means you are physically taxable as per the law of that country, but not liable to tax means the taxation is a sovereign right of each country. Whether the country wants to tax or not to tax is that choice of that country. You cannot impose on the world, every country must tax everybody. Now, country like UAE does not tax an individual. The countries like UAE taxes only the non-resident banking companies and non-resident exploration of oil companies. There is an income tax act which exists in Dubai, but only in respect of these two type of companies, not other individuals. Individuals are exempted. So therefore, similar is the case with the other Middle East countries. They tax the companies, they don't tax individuals. Saudi Arabia, Oman, they don't tax individuals. So therefore, the issue is whether the person concerned will be treated as liable to tax therein. Very interestingly, we have advanced ruling decisions, we have a tribunal decisions, and we have Supreme Court decision. Supreme Court of India, in the case of Azadi Bachao Andolan, a decision 263 ITR page 5, which are where they have taken a view. I have quoted all those decisions subsequently in appropriate places. You will find them. I'll also, when it comes to, I'll again repeat it. They have said the term liable to tax means you are potentially liable to tax in that country. It is not necessarily liable to tax means there must be an assessment made on you. You should file your return of income and you should pay some tax, or may file your return as exempted. It's not necessary. So potential tax, as and when the country decides to levy tax, they will tax you. Till then, the country has exempted you, and therefore you are not taxing, you are not paying any tax. Doesn't mean that you are not liable to tax therein. You are taxable, but country has chosen not to tax because that country does not need that big revenue for the purpose of managing that country. And therefore, the term liable to tax is a very well defined term as far as India is concerned. And Supreme Court, though the revenue is now objecting, because now they find whatever amendment they have made, we brought out this to them, their attention immediately after the amendment. Now, what can they do? Nothing. And therefore, they said, no, this is not our intention. This is that. Our intention is to not give exemption. But whatever they may argue, ultimately, Supreme Court of India's decision is a law of land. And therefore, it is binding on everybody. And Supreme Court said liable to tax means you are staying there by virtue of whatever criteria, because of your staying there. That country has a right of taxation. They levy the tax or not is not our concern, and therefore you are liable to tax. You will be treated as liable to tax in your country where you are staying, and hence you will get the advantage, and you will not be deemed to be resident of India. Of course, this is what our interpretation, and this is very valid, legitimate interpretation on the subject, and we have given this same view to number of the number of citizens, number of people who have sought our opinion on the subject, and they will not be treated as taxable in India. But this matter again, if the revenue rakes up, and we have, I have no hesitation in saying that you have excellent case to succeed before higher authorities. This was a proposed amendment. I don't want to waste your time. I come to the straightway amendment made in the Income Tax Act, and that amendment is exactly what I discussed. They said, again, to become a resident but not ordinary resident, you have 3 criteria. Earlier there were 2 criteria. Now we have 3 criteria. One, that you should be non-resident for 9 out of 10 previous years. You are a non-resident for 9 years. Then for next 2 years, you will be not ordinary resident. Second criteria, if you are in last preceding 7 years, you are in India for only 729 days, then also you will be treated as not ordinary resident for next 2 years. Now, third criteria is C and D, stayed in India in a previous year for more than 120 days, but less than 182 days, and you do not have foreign income exceeding 15 lakhs of rupees, then, you do not have Indian income exceeding 15 lakhs of rupees other than foreign income, then again you will be treated as resident but not ordinary resident. Now, there is some problem because of this type of criteria which have been added. You will be resident but not ordinary resident, but therefore you will not be non-resident totally. Whereas if the earlier only 2 conditions would have continued, you would have been non-resident. So you had a continuous period of non-residentship for more than, say, suppose 8 years are over, and 9th year you fix in this C, category C, then your break of 9 years, your break of 9 out of 10 years gets broken, you remain only in India for 8 years and there you will be impacted. So therefore, this was one obnoxious condition which have been introduced. I think it is necessary for even all the non-resident. The government only listens to non-residents. The Ramaswamy said, rightly said, you people have made big noise. As a result, the government came down partially, and it is necessary for you people to make representation saying that this is not acceptable, is unfair. And as rightly said, your whole major source of the India's foreign exchange reserves is all coming from non-resident community. And therefore, today we are so comfortable foreign exchange reserves. We are sitting on $508 billion. We have crossed $500,000 reserves in India, and that is substantial contribution goes to people like you. And therefore, you have political clout. You should be able to represent to the government. The individual, therefore, all stateless persons will become will fall under this category 1A, and therefore they will become resident but not ordinary resident. So once you become resident but not ordinary resident, consequences are very interesting. You will not be taxable on world income. You will be still taxable only in Indian income. Then what is the need of having this category? Indian income, anyway you are paying taxes if this is a taxable in India. If it is not taxable, anyway you are not paying taxes. It is not required to be paying taxes. So therefore, this category was absolutely nonsensical, not required to be added. But we have this condition, and that can create problems, because that can create a problem of continuous non-residentship of 9 years out of 10 years. That will get impacted. And also there are some other impact of this, which we will come to later on. But once you are a non-resident and not ordinary resident, some of the benefits which are available still will continue to be available to you. And therefore, we will come to that as a separate slide, which I have added by way of issues, which I will discuss with you, which I will discuss later on. Well, this is all repetition, so I will not waste your time. Residential test before the law was changed, the residential status after the law got changed, and there is new criteria India brought in to become not ordinary resident, a concept of deemed residency, which is based on the citizenship criteria. If you are not citizen of India, then this criteria of only 15 lakhs of rupees income applies. Not ordinary resident principle will not apply. Now, there are impact of that amendment is here, which I am coming to. Increase in the scope of income. The income from business controlled and profession set up in India by virtue of your becoming not ordinary resident becomes taxable. But if you are a non-resident, that income would not be taxable at all. Therefore, this comes under the clutches of the taxation, and this is one adverse impact. And when it comes to resident but not ordinary resident, though you are a non-resident for the purpose of and you are deemed resident, in that case, what will happen? There are certain concessional rate of taxes which are applicable to you under the exemptions are available to non-resident, not to not ordinary resident. That will get impacted, and some concessional rate of tax will be not available to you. The double taxation avoidance agreements, which are beneficial to some extent, they may get impacted. The rate of tax, for example, you have an interest income here in India, and the rate of tax under the double taxation avoidance agreement between India and Dubai is 12.5% on interest, not 35%. That will get impacted if you become resident but not ordinary resident. It will become taxable at the full rate, because then they will not give you treaty benefit. Presumption of control of a firm, HUF, in India, that is also a problematic area. Overall reduction in number of years of non-residential status for returning Indians, that I have already discussed. Out of block of 10 years, suppose you have just finished 8 years, and 9th year you are falling in this category, you will lose that 9 years continuity. The continuity is not relevant. 9 out of 10 years, there could be a break in 1 year, but suppose the break has already taken place earlier, then this could impact you. Clearly within the tax compliance of the framework. So once you become resident and ordinary resident, then tax deduction at source will be and filing of return in respect of that income will become relevant. Tax compliances framework will become relevant. The seafarers would be adversely affected on their income, those who are going abroad, and their specific relief provided by loss of the indirect transfer exemption on sale of units of FPI, which is available under the explanation 7 to the non-resident, but not this is not available to not ordinary resident, and therefore to that extent you will get impacted. The benefits of the non-resident, not ordinary resident status, there are some benefits also which are available. The slab rate available to the senior citizens will be available to you. The TDS deduction under section 195. For example, you have property in India and you want to sell that property and you are non-resident, the full rate of tax they will deduct. But if you are a resident but not ordinary resident and your taxable income is not fully taxable, you can apply for lower rate of tax. You don't have to go to the tax authorities. You can ask the payer, I am a resident only and therefore not to deduct tax. I'll file my return of income. That benefit is available to you. And then next is you are entitled to, if suppose you are resident and ordinary resident and you have got a foreign income in foreign country, you can, and that is taxable in India by virtue of any reason, then you can get a foreign tax credit as well. You can also avail concessional rate of DTA in other country. For example, you become resident and ordinary resident and you have got a foreign income. In foreign country, you can ask for low rate of tax if the rate of tax is lower. Of course, in Dubai, there is no tax, but in any other country. Then relaxation of reporting. Now, if you are a resident but not ordinary resident, foreign assets are not required to be reported in the return of income. Only the non-resident, only resident, pure residents are required to disclose their foreign assets in the return of income, and not ordinary resident or non-resident. Non-resident and not ordinary residents will not be required to report their foreign assets in the return of income schedule FA of the income tax return, and that benefit still continue to be available to you. Accessing the DTA treaty network for foreign source income will be available to you if you become a not ordinary resident. Some of the impact which are neutral. There is no obligation on reporting foreign assets, which I told you. Not ordinary resident will be treated as non-resident for the purpose of determining transfer pricing provisions and for the purpose of determining application of section 93. That is where the transactions of transfer takes place between two associated enterprise. Major changes under the FEMA residential status due to changes in the tax residential state. No changes in the FEMA residential status because of the resident but not ordinary resident. Black Money Act I have already explained to you. Now the law has been changed retrospectively. A person becoming non-resident, the crime committed prior to becoming non-resident, now the government says we can cash hold, we can tax you. But the law, when 2015 the law was introduced, the crime committed prior to becoming non-resident was not subject matter of any consequences, which was not liable to be covered at all. The UAE treaty, all other aspects I have already dealt with. Under the India-UAE tax treaty, the condition of becoming non-resident and becoming resident of Dubai is, or the Dubai UAE is, stay in that country for more than 183 days. Then, of course, I understand the Finance Ministry of UAE is giving tax residency certificate for those people who are even staying less than 183 days. That may be relevant or not relevant, but when it comes to you are taking position qua India, India is entitled to examine this thoroughly, and if you are less than 183 days in Dubai, they can deny you the treaty benefit. The treaty benefit can be denied, and the impact would be if you are taking a concessional rate of tax under the Dubai-India tax treaty, that treaty benefit will be denied and nothing else. There are no other consequences which will be relevant for the purpose of stay of 183 days or more, or concessional rate. Or for example, you are claiming yourself to be the resident, but you are not a resident of Dubai by virtue of this clause. Then any income which you are earning from India, that could be subject matter of not concessional rate, full rate of tax will apply. And that will be the major disadvantage which you may suffer on account of this implication. Friend, with this I will stop here and I will try to take questions in case time permitting after the next speaker completes his talk. And thereafter, if the organizers have no difficulty, I can prolong my speech little explanation little later explaining all the questions. I try my best to give you all the answers. Thank you very much for listening patiently.
Yeah, thank you, sir. Shall we take the questions now?
You want to take right now? You can.
Yeah.
You want to take after the next speaker? I'm available. I have no problem.
Okay. We'll take the questions now.
Okay.
One or two questions we'll take up now. Then.
Okay. Fine.
Okay. So
because these questions, I think you have sent me the questions, very interesting questions.
Yeah.
But I don't think the question answer session can cover up all 24 questions for answer. But if you want some special session for this, I don't mind coming back again on the Zoom and giving you answers for all the questions, which are very interesting, practical and day-to-day questions.
Exactly. So great of you, sir. Okay, we'll take a couple of questions now, then move to the next speaker. And if time permits, we'll take the balanced questions.
Sure.
First question is, if a returning NRI plans to continue his visa in foreign country and may visit UAE for 3-4 times a year, is his details of bank accounts in UAE to be declared to IT department? He may continue his service remotely to the company in UAE and its earnings will be credited in his bank account in UAE. As he has to visit UAE many times a year, he will have to spend a portion of his income in UAE. Is the money credited to in his account in a UAE bank will be taxable in India, or he can claim the expense from it and tax will be payable only on portion he remitted to India?
Very interesting, real life scenario. This happens, but the question is, remotely, when you are saying, I assume remotely from India, if it is services are rendered to that company in UAE remotely from India, and you are staying virtually in India and doing all the activities, you will be resident, and therefore once you are a resident under the Income Tax Act, because your residential stay exceeds 182 days. But if you are visiting Dubai 5 times in a year, and your number of days total stay in Dubai exceeds 182 days, 83 days in that case, then you cease to be resident of India, you will be non-resident. Now the question is, I will give you implication both ways. If you stay in India and remotely rendering all these services, and you are casually going to Dubai for 1-2 days and resolving all the problems and coming back 5 times in a year, so 10 days or so, then in that case, there is no doubt that you are a resident of India and you have opened your company abroad, you have opened your bank account abroad, you are earning your income from Dubai activities and crediting that account. It will be your obligation to bring back that income within India, to India, back to India within 30 days of crediting to your bank account, because it is your obligation under the Foreign Exchange Management Act that income earned by a resident abroad cannot be maintained in a foreign country unless you take Reserve Bank of India's permission, and RBI says, okay, you are permitted to maintain the account and give yearly account to us and bring back the money only at the end of the year, then it's a different story. Otherwise, you have to get the money back in India. You are entitled to spend the money for the day-to-day expenses there also. There is no problem. But you will have to report all those expenses also to the Reserve Bank of India. And therefore, once you are a resident, consequences are different. But by virtue of your stay abroad, maybe not necessarily in India, not necessarily in Dubai, number of other countries, anywhere, wherever you are global travelers, and you are rendering services remotely to the Dubai company, and you are ensured that you are not in India for more than 182 days, then you are non-resident of India because you are employed in a foreign country. And once you are employed in a foreign country, your earnings abroad can be retained abroad. You can spend lavishly without difficulties of RBI's control, and you don't have to bring back that money into the country. Your earnings abroad as a non-resident, you can retain abroad, and you can invest out of that also in abroad, in foreign country, or even in India. There is no restrictions, but your residential status under the FEMA must be non-resident. If you are a non-resident, you are free bird under the FEMA. If you are a non-resident under India, under the Income Tax Act, you are free bird from taxation purposes. But if you are a resident in India for income tax purposes, then everything has to be the taxable here. But you are a non-resident under the FEMA and resident of India under the Income Tax Act. You can retain your income abroad and pay the tax in India and still retain the balance net proceeds out of India. You can take advantage of both the worlds. All the situations are has to be looked into differently, separately in respect of each situation.
Okay, thank you, sir.
Thank you.
We'll take one more question now.
Yeah.
This is a question from George from Dubai. If you have a property in UAE and get regular rental income, what happens once an NRI becomes resident in India and how this income is treated? Whether this rental income will be charged to Indian income tax? This is the question from George Dubai.
Yeah, if you become resident, purely resident, if you become resident but not ordinary resident, that income still will not be taxable. It will be out of tax net in India. But you, assuming you become purely resident of India, then India will have a right to tax on the world income, including the income from foreign rent of a property situated abroad. And then that rental income will be taxable here, and you will have to, of course, you are invested into that property when you are non-resident. You are entitled to keep the rent abroad in your bank account. There is no reason why you have to bring it back into the country, but income tax you will have to pay in India on that income. So your reporting will be required. When you are required to file your return as a pure resident, you will report your foreign assets. You will also report corresponding income from that into income tax return, and there will be cross tally. Income tax department will tally it. And therefore, and not only that, nowadays you have very interesting situation. The countries are communicating with other country. There is an exchange of information program. Under the exchange of information program, the Indian Revenue Authority is writing to the UAE Revenue Authorities, UAE Authority, Finance Ministry, get the information about this person and in respect of his bank account, in respect of this property, how much income he has. The finance ministry of your country can ask this information to you and submit it to the Indian authorities, provided you are resident of India. You are resident of Dubai, you are resident of that country, no authority will ask any information to you to submit to the other country, because it is nobody's interest to submit information about residents to some other country. And therefore, a lot of people are becoming resident of UAE only for this reason.
Thank you, sir.
Thank you.
Thank you. It was an excellent session. The number of questions balance remains. We'll take at least 1 to 2 hours to answer. Time permits, we'll take all these questions at the end of the next session. Now we are moving to next session. Ostwal sir, thanks a lot for your excellent and marvelous presentation. We are all excited, but due to the paucity of time, we are restricted now, and time permits, we'll go for the question answer. Okay.
No issue. And if you want to really create a separate session only for question answers, I am available. I can render you all the services.
Nice of you, sir. Thank you very much.